it start to look more attractive, very attractive. I'm talking about a Hamilton Canadian Financials Yield Maximizer, or HMAX. So for people who are considering buying this ETF, they'll look at the price. They're like, well, it was 16, right now it's 13, and it's keep falling. What's the reason behind it? And for people who own this ETF, they're maybe wondering why my ETF that I'm holding right now keep falling. So, and you're wondering, should you sell it or should you hold? So on this video, I'm going to cover that and tell you what exactly why the stock is keep falling, or this ETF particularly is keep falling from all the way 16 to now with 13. And of course, as it falls, the yield keeps going up. So on this channel, if it's the first time, Mr. Banban channel, on this channel, I always talk about passive income investing and growth investing, as well as any most thing to related to your finance. So if it's the first time, just make sure you subscribe, and if you like my content, give me a like. So for people who are maybe not familiar with this one, this is pretty much our, it is our, there's pay monthly distribution, and is diversified exposure to Canadian 10 largest financial with approximately 75% exposure to big six banks. And they do dynamic cover call writing. That's the strategy they use. Dynamic. There are two type of different type of cover call, but they use, of course, dynamic. And of course, it's good for people who are looking for high income, and it's blue chip companies to have exposure to that, and it's tax efficient. And also people who wants to reduce volatility in their portfolio. And the objective of this fund is designed for attractive monthly income while providing exposure to market cap weighted portfolio of Canadian financial service stocks. Okay, to reduce volatility and augment dividend income, HMAX will employ an active cover call strategy. So, because of course it's stocks, when you combine them together, they don't pay 15% in dividends, right? There will be more of maybe 7 max, but because they use that strategy of cover call, they can pay that 15%. So that's kind of like just introduction to this fund. Of course, it pays monthly, and we look at the price right now is $13.84. Yield is 15. And we look at the allocation. We look at the allocation is right now we have management 10.1. There's the management financial management company. Bank is 74, and we look at the insurance is 15. And these are the banks here: Royal Bank, Toronto Dominion Bank, Bank of Montreal, Bank of Nova Scotia, Brookfield Corp, Canadian Imperial Bank, Manulife Financial, Sun Life Financial, Intact Financial, National Bank. You can see the biggest one is Royal Bank. So, and then we look at distribution is monthly, and they rebalance semi-annually. Management fee is 0.65, and investment style is covered call. Asset under management right now is about 5.29 million. So it's a pretty big. We look at ticker symbol, of course, is HMAX, and it's traded on Toronto Stock Exchange. And if you're wondering what makes HMAX different than other financial ETFs, is because they say here many cover call ETF write option on 30 to 50% of a portfolio out of the money. HMAX is able to provide a higher monthly income with a dynamic cover call strategy, currently writing option on 50% of the portfolio at the money. So you can see here they only put 50% of portfolio, and then the rest is kept for growth. This allows HMAX to generate a higher option premium while maintaining 50% upside potential. So that's what makes different. So we look at the reason why this fund actually keeps going down. Look, remember I told you here, look at these banks. The first bank here is Royal Bank of Canada. And we look at the HMAX, look at the Hamilton Canadian Financial Yield Maximizer. Look at the chart right now. You can see year to date is going down that way. So let's look at the biggest bank that this one holds. That was the Royal Bank. If we look at the Royal Bank, look at that graph. And if you look at that chart, and if you look at the Hamilton chart, they look pretty similar, isn't it? Let's look at the second bank, all right, which is Toronto Dominion Bank. Look at that year to date. It's also down right now. So at that point it was about 65. Right now is down to 61. It went all the way to 60. So let's look at the other bank, Bank of Montreal, which is the second one. Look, the chart looks the same. We look at the Bank of Nova Scotia. It's pretty much the same. All these banks are really down right now because of interest rate, of course. And we look at Brookfield is the only, I think, company that's a little bit high on the green year to date. But a little bit, not too much, because it started about 32. It's pretty much almost flat because it was actually at 32 and now it's about 32.75. So it's also flat. It hasn't gained any much. We look at the Imperial Bank, Canadian Imperial Bank of Commerce. It's also down year to date. That's just something I just want to show you. The reason why HMAXs keep going down is because not because there's anything fundamental bad about this particular ETF. It's just underlying ETFs, underlying stocks. I mean, these stocks right here, they're all down, and it's because it does write calls, and also there's that 50% participation in upside potential. But right now there's no upside potential. Everything is going down, and of course this fund will be going down. So that's all for today. I just want to show you why HMAX it keeps going down, and is it time for you to buy? I would say if you really believe in the Canadian bank system, these banks right now, they're very strong in general. So I believe in these banks, and I believe they're going after the economy. We know this settle of this interest rate is settled and everything like that, and recession fear is gone. These banks will be going up. Of course, there is a 50% of that participation for HMAX. So HMAX will start seeing HMAX also going up. That's what I can tell you. And that's all I want to cover today. And again, if you like my content, just give me a like. If it's the first time, give me a subscribe. Thank you. Bye bye.